Practice mode.
Yeah. Good morning, everyone, and welcome to Louisiana Central's Greg Crabtree webinar. I'm a little tongue-tied this morning. I've only had one cup of coffee. We're excited to have Greg speak to our group again. He spoke to us, it seems like last year, but I'm sure it's been 4 or 5 years. And he brought with him his book at that time, Simple Numbers, Straight Talk, and Big Profits. And it has really transformed how I coach entrepreneurs, the things that I've learned from Greg. And so I've taken to calling this the Bible. And every time we have questions, I'll say, well, we got to look that up in the Bible. And as the world changed, now Greg has a new book out, Simple Numbers 2.0. So I'm going to have to start calling this the New Testament.
Yeah,
but
that's right.
It's we're in for a great morning. Wayne Mullins, if you will kick us off.
Absolutely. Good morning, everybody. Thank you so much for making time on your Wednesday morning. It looks like we've got quite a few people coming into the room right now. Got Andrew and Annie and Evelyn and Jenny, and I'm not going name by name. We got a lot of people in the room here. So just a couple of quick housekeeping things. So number one, if you could, devote this next hour, turn off your phone, turn off notifications, shut the door, because what Greg is going to share over this next bit of time together can really, as Gary just said, impact not only the way you do business right now, but the future of your business, what your business is actually worth in the future. So I would really encourage you to treat this next hour together with some serious intent, and grab a pen and paper, be ready to take notes. Two quick things that I do want to mention. We are going to be giving away some copies of Greg's new book, Simple Numbers 2.0. There are going to be 2 ways that you can get a chance to win a copy of this book. The first one is going to be asking questions. So if you ask questions, you will be entered for a chance to win. The second way is to stay to the end of this presentation. So stick around till the end, and you will also be entered to win. So without further ado, I think Gary did a great job of explaining the importance of what Greg teaches, what Greg sees from working with his clients all over the country. Greg, I'm gonna go ahead and turn it over to you. Thank you so much for being here.
Yeah, thanks so much. I really enjoyed visiting last time, and hope to get back down there in person as soon as things open up. And I've actually been out on the road being in person at events. So I think that wave is coming. First off, I was actually in the studio the last 2 days recording the audiobook version of the first book. So I'm probably in about 2 months, I'll go back and record the second book. So I've finally gotten around to actually doing the audio version for those that just like to listen to stuff as they're traveling or consume books that way. It was actually the first time I'd read the first book from cover to cover since I finished writing it. And I have to admit, I got to the end of the book and I said, that was a pretty good book. And so I even surprised myself. But one of the things that really has come out, this last year has just been a totally different year, obviously, for everybody. But as I worked on the new book, we had a study model that we had been working on for years that had about 50 companies in it. We upped it to 100 companies in this last year to get some clarity of trying to see what really was happening. Because unfortunately, as much as the news media tries to present financial information, they do a pretty poor job of actually getting to facts. And so we just said, okay, well, we're data people. Let's look at data. What does the data tell us? And really what we found was this 100 companies, it's about $1 billion of revenue. It's all different industries, all different geographies from Cape Cod to California. So the nice thing about our practice is we're not geographically limited, and we're not industry limited either, even though we have a few industries that we have a few more clients than others, but we touch just about all of them. What we found is going back to the first model that started as a base year in 2013, Regardless of your political affiliation, here's the deal. I believe in the party of entrepreneurs. The party of entrepreneurs are the people who make things happen. They create business, they create economic activity, they create jobs. They're the people that are really, I think, is the backbone of the American economy. And much more so in the last 10 years than ever, in the sense of business has shifted more to the privately owned business sector, much more than the publicly business owned sector. And in that process, what we saw was, even starting in 2014, the growth year of our model said those businesses grew at 20% in 14. They grew at 14% in 15. They grew at 15% in 16. First year of Trump's administration, they grew 22%. Second year in 18 was 12% growth, and in 2019 was 8% growth. Now, the politicians would like to take that data and make a lot of assertions. At the end of the day, I'm going to tell you it's simply as this. When there's always plenty of demand, it's when the market runs out of resources is when things slow down. And what we saw at the end of 2019 was the fact that we ran out of labor. And as I reminded myself as I was reading the audiobook version of my first book these past 2 days, I kept hammering home this idea. It is about labor productivity that drives business. There is nothing that any of you listening to this today can do positively in your business without the productivity of labor. And we've got to get that through our heads as businesses, because everybody's really longing for that thing of, I want to start a business that I don't have to deal with customers, I don't want to have to deal with employees, and I'll make a lot of money and I won't have to work very hard to do it. Well, that's called fantasy. And at the end of the day, it is about whatever you decide to do in your business and making those things productive. That's really what matters. And when we got down to the bottom of the barrel of available labor at the end of 2019, that's what we saw. We saw a slowing of the private business economy because there just wasn't anybody to get anything done. Then COVID hit. And so we're running about 8% year-over-year growth. In April, in the first month of the lockdown, we dropped about 25% year-over-year for that month. The month of May was back up to about 15% down. And then June was actually above the previous year. They actually got a little bit of a bump coming out of the lockdowns. And then you settled into down about 10% for July and August. And then September was another bump. By the time we got to September, if you take rolling 12 year over year September, we were only down 3%. Then you go into the end of the year. We actually finished up 6%. So that $1 billion of revenue, that 100 companies actually finished the year up up 6%. Now, there's winners and losers. We didn't cherry pick the winners. We didn't cherry pick the losers. It's just, hey, we kind of came to it. The first 100 companies we could think of that we had data, that spanned, at least a 4-year period of time, on that. And so what we saw was quite interesting in the fact that even the good companies increased profitability. And so what they ended up doing was, even though that they were still having good activity, they tightened their belts. They started looking at expenses critically, the way I suggest. And you don't budget, you don't spend what's in the budget, you spend for value. And so what they looked at is they trimmed everything that wasn't necessary. They really, crisis has a tendency to cause you to focus. They trimmed unproductive labor. We saw about a 10% reduction in direct labor. We saw about a 5% reduction in management labor. Typically, what you're going to find, management labor is a lot harder to replace than direct labor in many cases. And so people had a tendency to believe, let's kind of like the way Jack Welch used to talk about it with GE. You terminate the bottom 10% of your workforce every year to really try to refine it and get to the best and best of the workers. So in that process, here's the next thing. So the companies were up 6% for the year. They were up 2% in profitability. So at one point through September, they had actually made more profit on a rolling 12 basis, being down 3% for the year, than they had the previous year. By the end of the year being up 6%, they went, and don't take 8% as the average, but they were at 8% profit going into COVID. They finished the year at 10% profit, which is significant for $1 billion of revenue. Now, here's the next thing, cash. I will tell you right now, I have never seen this much cash sitting on people's balance sheets looking for the green flag that says go. Now, we're starting to see the go sign. We just saw it probably the first week of March as that winter blast came through the South and created all kinds of havoc at the end of February. It's like it warmed up that next week, and all of a sudden, all the calls that we were having with our clients that, since then has been, okay, we're going. And we're starting to see that activity. I think March is going to be a really good month, for a lot of people, and that activity is out there and people are really hitting the go button. But that 100 companies of $1 billion of revenue, they had $30 million in net cash going into COVID. So that's cash minus line of credit. They finished the year at 100 million. 100 million. Over 3 times as much cash is sitting on people's balance sheets now than what was there pre-COVID. That's not a statistical anomaly. That's company after company after company. Now, here's the deal. People can argue about PPP all day long. I consider it probably one of the most brilliant, maybe lucky choices that the government decided to do, but I'll give them credit for it. I think it was huge, not because it gave people money they didn't need. What we saw going into COVID was an immediate constriction as soon as the lockdowns occurred, that AR shot up and accounts payable shot up. What we saw before PPP got released was people started hoarding and people started holding on to their cash. And had they not issued the PPP loans in April, we would have been in a world of hurt. Everybody would have extended terms and business would have stopped. One of the things I've been fortunate enough to do, actually right before COVID, I did a speaking tour in the United Arab Emirates and in some of the countries there, as well as East Africa. And when it really dawned on me, and I've been able to present my material all around the world, and as I do that, it's always interesting to talk to the local entrepreneurs and kind of find out how the economy works. Well, at the end of the day, I will tell you, there's only one difference between a third world economy and a first world economy. It's called the speed of cash moving through the system. The more you can make gross margin flow quickly through a transaction cycle from beginning to end, and everybody treated fairly as the cash flows fairly through that cycle, we all win. When one party holds up payment, all of a sudden you see the economic activity decline. So this is really where I would say that the good in people showed up and the good in businesses showed up, in that I've seen more friendly terms issued in the last 12 months because of COVID, even with large companies extending far more favorable payment terms to smaller companies. I would urge everybody to continue that process, not to where you're benefiting unfairly from somebody else, but work fairly with everybody as cash flows through that cycle. When it does that, a lot of good things happen. It doesn't take near as much capital to fund your business. And I talk a good bit about capital formation in the 2.0 book. And you can really launch a business with a lot less cash, but you also make it fair for everybody as it works through the system. And really, I hope the larger companies continue that and they don't start to, extend payment terms for them to just make a few points of interest. Fortunately, right now, there's not a lot of interest to be made. And so they're not really motivated to hold on to cash, but we're going to hope that stays. And I'm going to be one of the loudest voices saying, listen, we don't do the economy any good when everybody holds everybody else's money. It's interesting, in these other countries, the biggest culprit was the government. The government was holding payment. Now, fortunately, in the U.S., we have an exemplary payment system for federal payments for the most part. And in most states are actually, quite good as well. You're going to get into a few other circumstances in some pockets where maybe not, but these governments in these foreign countries were really trying to accelerate the entrepreneurial activity, and yet they were the worst offender of the process, in that process. So hopefully they'll learn, from that process. But in our case, like I said, we enjoy, this great opportunity. Here's the other thing. Many of you are in the field of marketing. So we have a lot of clients that are marketing firms, and we monitor marketing as one of the key expenditures of business that is an accelerant of business growth. Coming into COVID, that 100 companies were spending 1.7 million a month in marketing spend. As soon as April hit, that spend dropped to 800,000. So over half of a reduction in marketing spend. By the end of the year, it had only climbed back up to about 1.1 million. And then I think probably March is going to be the first month that we've seen since the lockdown that these companies will be back to their actual pre-COVID marketing spend. Many of them, the ones that were spending, were the ones that still had activity, and there was a market to go talk to. There, I've got clients in the cruise industry that there's no sense in spending money marketing because they don't know when they can sell a cruise. And so there's still a little bit of that dysfunction, in the process. Now, here's the thing. The world didn't end. A lot of companies have more cash than ever, but there's a handful of companies that were severely affected. If you're a restaurant, if you're in the travel industry, if your business was largely tied to a single business entity, that you're tied to their fortunes, and they were one of the ones that certainly got hit. We had a client that did consulting for the airlines in agile software development processes, and one of their largest customers, obviously, they terminated all the contracts that were in place because they had to hunker down. Well, now they're back, so those are the kind of things is did you get by? One of the things that I thought was kind of interesting is when you look at the PPP loan calculation, it kind of validated my 2 months of core capital, concept, because if you really take how the PPP was calculated, it is almost exactly my 2 months of core capital number. And so we typically saw one of two circumstances. We saw people who had followed our guidance, which fortunately was quite a few, that ended up with cash sitting on top. And so now they've got some bonus cash that they can really be aggressive with and make some investing decisions off of, to grow the business. And then you had another group that had not done that, and they got manna from heaven. And so now that PPP loan got them to their proper cash balance number. And we saw a lot of people who were generally pretty sloppy with cash all of a sudden learn how precious having cash was. And hopefully they will stay. If you're one of those that got some PPP funds, don't go back to living off of no cash or living out of whatever dollar you have, you spend it or do whatever. You've got to establish that base cash balance. And that's, one of the keys, that we really learned from the process. But really at the end of the day, I mean, it's kind of one of those things that I think businesses are far more in better shape than probably most people believe. And if you are severely affected, then you've got to do some soul searching and say, is my industry coming back? Can I make it? I did a presentation a few weeks ago for travel destination planners, and and certainly their industry has been really hit hard, but they're hanging in there, and so they're all looking forward to people will have a lot of pent up demand to travel. There's a good bit of cash also on the personal side of things. One of the things that's not talked about widely is personal credit scores went up 3 points during COVID. So there's actually a decent amount of cash in a lot of people's pockets as well, because they made different spending decisions, during this process. So whatever your business is, just kind of be prepared for those things. So I'm going to share a couple of slides here of things, from the new book. I'll kind of pop around from a couple of these because we don't have enough time to probably go through all of them. So interesting thing about the new book is I call it Simple Numbers 2.0, Rules for Smart Scaling. And so, and actually, I forgot to update the top side. It actually is available. So you can go to simplenumbers.me to get it if you want to get it directly from us, or you can go to, it's available on Amazon, as well. We call it Rules for Smart Scaling because we see people who are trying to grow. And when we do our initial planning session, with those clients, we see, okay, you might have grown from $3 million to $5 million, but you didn't make any more money. And in many cases, you made less. And you go, well, what good is that? I mean, that's no fun. And so, if you're going to grow, you need to do it smartly. And what we've been able to find out is a couple of interesting ways to really hold yourself accountable of techniques to really find a way, to grow smartly and do it, in the right way. One thing I will say, since I visited last about a year ago, our firm merged with Carr, Riggs and Ingram. So we're now part of their, it's a top 20 accounting firm. They have offices pretty much through the South from North Carolina all the way to New Mexico, based out of Enterprise, Alabama. But they've been growing and adding firms through the years, and it's been great. They've really helped us in areas that we were resource constrained, and then we're kind of the oddities in their practice of doing consulting. But I can't be more pleased in terms of being able to be a part of them and being able to tap into some additional resources. And they've certainly helped me be a better practitioner myself. But essentially, we still have our same 40-person office in Huntsville. But we're we're not geographically focused on Huntsville. For the most part, like I said, our clients are kind of all over the U.S. and all over the world. I start off the second book, and this is something that, especially as you come out of COVID, I want you to go back and reset your mindset about your business. Now, I was talking with a client of mine up in Canada, and I was visiting them, and we were having dinner. And as business geeks, we sit around and talk about business because it's fun. And I just kind of blurted this thing out, and it really kind of formed the kernel of the next book. And I said, really, there's really three keys to business success. The first one is figure out what the market needs. Now, what's interesting is we saw in the last year of probably one of the harshest times for businesses to be looked at critically and say, are you a necessity? Are you a luxury? Are you a discretion? And so in many cases, we saw things that we thought were discretionary become absolutely necessary. Delivery services of groceries, delivery of food, distribution of food, and all different types of food. And you start to see during shortages and those kind of things, what things people really consider, essential, and versus what things people kind of consider, I can do without that. And what, like I said, in the data set that we looked at, you saw even good businesses make more discerning decisions about expenses to say, I can really live without that. I think I'll turn it off and just see if I miss it. And most of them never turned it back on. Now, figuring out what the market needs also includes how you interface with your customer. Just think about in the last year, how many businesses adapted their websites. And I'm just constantly amazed at the speed in which restaurants adapted their websites to be able to check for curbside delivery versus web pickup, and are you going to order in? Are you going to eat out? And all of those different decisions. They adapted to that, and a lot of people made different kinds of decisions of how to interact with that customer, and so really, each of you need to think through that and say, whether it's a product or a service, how needed is my product or service? And what did the market respond to me in the past year that gives me a sense of, do I need more reserves through a time of harsh economic circumstances where my demand may fall? Or am I going to be good pretty much, throughout just about any kind of activity? Once you get through discerning, do I need to act differently with my customer? Are there other things that will, meet in market need? Then the next piece is the part I feel the most comfortable with. Find a way to do it profitably. Now, here's the thing, though, that most of you fall into the trap of. The first thing that happened in the lockdowns is people's activity slowed down. They gave the natural reaction of cutting prices, and yet it didn't change demand. And what you realized was you're just wasting money. The people who were going to buy or use whatever your product or service was, they needed it. They weren't price sensitive. And so when the market is disrupted like that, it's really a time that you needed to raise your prices more so than lower them. You weren't going to increase demand by lowering them. And so we saw many people make that initial false move, and they've gone back and readjusted prices. And just think about the different things that you pay for now. One of our clients was a medical supplies distributor, and they had previously not done any distribution in medical gloves. But they kind of found there was a high demand for that. They found a source. Now, this is the stupid thing about a particular thing like a surgical glove. Those things went up 5 times in price over what the pre-pandemic cost was. The medical glove marketplace, the manufacturing capacity was at 98% plant capacity going into it because the demand was so known, they didn't have any excess capacity. Once there were shortages, all of a sudden prices shot up. And I mean, it's just like a feeding frenzy. On the backside, now is a lot of those surge activities or scarce items are now becoming, back online. You don't want to be the person holding the bag, holding inventory that's going down in value every day, that is not worth what it was. It's going to go back to its normal. And we had a few clients that tried to speculate and do some things, and really, we always gave them the cautionary tale of, hey, what goes up does come back down. It is physics. And some of them, we got a couple of them that are holding millions of dollars of stuff that aren't going to be worth what they paid for it. And so, you just got to kind of beware. The people who stuck to kind of, here's what we do, we're going to do what we do, we're going to, keep focused on that. They really looked at it from a different standpoint. And what we tried to get them to do is the typical business owner prices their goods from a cost buildup methodology. So you sum up all of your cost, you add an expected profit that you'd like to make, and then that's what you try to charge, and then you kind of negotiate from there. And what we've really tried to emphasize, especially during COVID, is to go a different direction. Start at the top. Start at what do you see the market willing to pay for this product or service? And then you backwardly engineer what is the least amount of cost that I can get away with and still deliver on the quality and timing and the perception of that goods or service in that process. And what we found is some substantial increases that people have been able to make because they really had fallen into what I call pricing bias. And pricing bias is absolutely real. When we do a client session, we pull their data and I look back at across the last 3 years. And when I see exactly the same contribution margin percentage to revenue for 3 consecutive years, and I say, well, I'll give you an A+ for consistency. I'll give you a D- for pricing bias because you're leaving profit on the table. There is no way that contribution margin stays exactly the same percentage to revenue for 3 years unless you left money on the table. Now, if you're okay with leaving money on the table, then that's fine. But I'm telling you, you're leaving money on the table. There's no doubt. Now, once we figure out how to do that product or service profitably, this is the part in the new book I spend a lot of time focusing on, and it's a concept called return on invested capital. Now, invested capital, in a perfect sense, is the same thing as equity, except your business is never perfect. So there's typically you're taking equity in the business and making some adjustments to it. So think of it like this. What are the active assets that I need to run in my business? So what's the cash balance that I need to have? What's the accounts receivable? What are the fixed assets? Those are the asset side that are active and needed in the business. And then what's the funding that I get from vendors and accounts payable? What's the funding that I get from maybe customers paying me in advance and I have customer deposits or deferred revenue, maybe some accrued expenses. It's the net of those things that are your invested capital. I'm not taking on so I'm taking, if I have long-term debt that's connected to those fixed assets, I net those two things together. And so if I have a clean balance sheet of assets and liabilities, what's the net of that number? That's my invested capital. Now, as entrepreneurs, we get a little messy. We have a tendency to own assets that really have nothing to do with the day-to-day ongoing operation of the business. They may have at one time, and now they're not used. I may borrow money from the business. I may give money that I have in my business to an affiliate or a related party. I might borrow money from a related party. Those are extraneous things. What you're really trying to get to is saying, if I really started my business from scratch today at the current rate of pace that it has, what's my average receivables, inventory, et cetera? What's my average payables and so forth? The net of those numbers is invested capital. This is the part that I've learned since I wrote the first book. Is in the first book, I said 5% profit is life support for most businesses. 10% is a good business, 15% is great, and you better take it while you can get it, because the market will kind of compete you back to that level. Now, that was actually a pretty good observation, because those numbers still hold true about 70% of the time. But there's certain business models that operate outside of those numbers, and both higher and lower. And I had to have a way to say, well, why is that? I want to know the why, not just observe. And return on invested capital is the answer. What I found is in the US marketplace, because of the speed of margin that flows through, we enjoy what I consider a minimum acceptable return on investment of 50%. So if I have $500,000 of invested capital, of assets minus liabilities, to run the business in a fully capitalized state, then I should make a minimum $250,000 of profit. And so when we do this, find a way to do it profitably, step two part of the equation, if it takes $500,000 to run the business at the pace it's currently running at, then you better be making $250,000 in profit. We did a project for a Louisiana client here in the last couple of weeks, and their invested capital, was right around $5 million. And, we basically did that calculation, and their profit target has to be 2.5 million. Well, they'd had some years previous that were well below that number, and their most recent year, was about 1.5 million. And I said, great, you're on your way, but you need to find that other million. You're not being progressive enough to produce the profitability that investment requires. So you've got one of two choices. I've either got to bring down the level of investment by getting paid faster, not carrying as much in receivables or inventory, or I've got to increase profitability. It's one of the two. And it's really been an enormous tool for us to really help large and small businesses really fine-tune their targeting, and also understand more about why one model of business model gets 15% profit, and why another business model is really good at only 3%. We've got a distributor client that's over $100 million in revenue that makes 3% net income, but it's because they have very little capital deployed, because it's a distributor relationship where they don't pay for the goods until they get paid. And so their vendors are essentially their funding partner in turning over those. Now, sometimes they're willing to do that, sometimes they're not, but it helps you understand that if you can't achieve this level of profitability or this level of pricing for that goods or service, then you got to go back to the drawing board, and you got to say, listen, I need to be able to challenge this and go back and say, there's got to be a different way of doing this, because I've yet to see a US-based business not be able to achieve the 50% return standard. And oh, by the way, the average is closer to 75 to 100%. And this is an essential thing that I try to convince the entrepreneurial community, that owning a privately held business is the greatest way to build personal wealth if you can operate it effectively and do what the market needs. And if you're able to do that, you're able to get a great return on that investment. And then you're motivated. It's kind of like if I went to Wayne and said, hey, Wayne, I hear you got $100,000 to invest. And how about if I gave you 100% CD for 1 year? Well, Wayne would probably say, gee, that sounds pretty good. And said, all right, so a year later, I come back and I give him his $100,000, and here's his $100,000 of interest. Oh, wait a minute. That $100,000 of interest is taxable. So IRS is going to get about 40% in the state. And so I got $60,000 net after tax. So that's $160,000. And then so now you get to the next part of the equation. Hey, Wayne, would you like to do it again? And his answer should be absolutely yes. Now, the question is, I know that I can deploy the $100,000 of principal because I've been doing that. Can I deploy the extra $60,000 that I made net after tax and leave it in the business to take it farther? That's the challenge. And what I will tell you is growth in our rules for smart scaling, it's far more about your ability to execute on strategies of growth than it is about cash. Cash is rarely the actual problem of scaling. It is really, are you good at executing? Are you good at making good bets into the marketplace and using a catalyst to actually push that growth in that process? So since we have kind of limited time, I want to go to so one of the things that we talked about in this return on invested capital is I took the balance sheet and I broke it down into three components. So we have what we call buffer capital, which is your cash minus line of credit. That's pretty simple. We have infrastructure capital, which is your fixed assets, net book value, minus any debt connected with that. So if I own a truck that's worth $50,000, but I borrowed $40,000 on it, my net fixed asset is $10,000. And then the magical piece is what we call trade capital. So trade capital is, any of you that have had traditional financial training, you're familiar with the term working capital, current assets minus current liabilities. Well, I will contend that the concept of working capital is inherently flawed. It's like it finally dawned on me why this was a stupid number. And it's a stupid number because it never should have had two components in it. It shouldn't have had cash and debt. What we need to know is trade capital is all of those things of AR plus work in progress plus inventory minus accounts payable and deferred revenue and accrued expenses. It's the net of those numbers that's the cash that's in this barrel that you're turning over month in and month out, month in and month out. And it'll get a little bit bigger and it'll get a little smaller, a little bit bigger and a little smaller. But across time, it flows at a fairly consistent percentage of your revenue volume in that process. And it's a relatively easy number to predict unless you act on it to intentionally. You can't eliminate it, but you can move it. If you get sloppy, it gets bigger. And if you get more efficient, it gets a little smaller. And so that's the critical number. Those three numbers of buffer capital, infrastructure capital, and trade capital makes up the complete balance sheet. That's everything on the balance sheet. Anything left over shouldn't have been on there in the first place. It's not relevant to the business. But there's a fourth capital, and it hides on your P&L. And this was the other aha moment, because really entrepreneurs use these words very sloppily, and so do accountants. And so, we interchange the word capital and debt. Well, you should never do that, because debt's debt, capital's capital. They're two different things. Debt at best is a temporary replacement for capital, but at the end of the day, those are different terms. And so in the sense of, most people would think capital is something that goes on the balance sheet. Well, that's not entirely true. And so let me scroll down to this. So essentially launch capital, everybody think about it like this. Think about 2020. What did you spend in 2020 that wasn't needed to be spent to produce the revenue in 2020? You spent it to try to get to someplace else or to get even higher in 2020, but it didn't work. It was essentially a bet. Now, typically those things come in the most three predominant categories of launch capital are marketing spend, labor that you hire before you could fully utilize it, or technology development expenses. Now there's others, but those are the three predominant ones. And so these are things that you spend money on that don't hit the balance sheet. They hit your P&L. They are uses of your profitability. And so these are catalysts. And so what we try to do is get people to identify, first, you want to look back at history and say, well, what did I spend it on? What was my catalytic spends? And then you evaluate it and say, did it work? Did it help in that process? And what we've tried to come up with some innovative ways. And I'm going to show you a case study example of an actual client that grew from 700,000 in revenue to 10 million in 5 years. And they allowed me to share this example in the book as a case study. And so this particular business, they were doing 700,000 a year back in 2012. And so their one catalyst was marketing spend. So they had spent 75,000 the previous year. They're going to add 121,000 to it. So what we have to do is say, okay, I'm all for that idea, but what does success look like? I mean, that's really what you've got to paint a better picture of. And we say, okay, well, if I add $121,000 to it, then let's go back to my 50% return on invested capital standard. Well, I'm betting $121,000. I got to make the bet first and risk losing it to ever get any success. And so therefore, if I put $121,000 of my profit into this, I need at least a 50% return. Now, if my profit increases by this $60,000 down here, that means that I will have gotten my investment back and made 60,000 more on top of it. So that's when I say 50% return, that means I got my money back and I got 50% more on top of it. That's a good deal. I think we'd all agree to it. Now, other thing I want you to notice here, it's a 50% increase in net income. I don't really care what revenue increases to. I don't care what gross margin increases to. I don't care what these other operating expenses increase to. What I care about is net income. And if net income doesn't increase, why do we do it? I mean, so that's the critical measure. I get that you can measure those other things to get indications of success, but you still have to execute that. If that new dollar of revenue comes in, does it trickle out additional profitability below after the cost to acquire it? So let's see what they did. Well, they got close. They got to 45% return. So they moved from 63,000 net operating income to 118. Revenue went up significantly, and most people would be cheering, but I'd be going, well, that's great that you got to 2 million in revenue, but we're at close to this life support profit number. So guys, we got to get some more profitability. So I like the fact that we're growing, but let's be judicious and make sure that we can, keep this train going. So they said, okay, so we're going to add another 103,000 to what we spent. Now our new profit target's 170, and that's our minimum target. And so they said, let's try it again. Well, this time they blew it out of the water. I mean, they jumped to 628,000 in profit. So where we were only looking for a $51,000 increase, this really took off. Now, I get it. A lot of what was spent in 2013 came to fruition in 2014. That's just the challenges that you got of connecting marketing spend to outcome. Sometimes it's a short life arc of that spend. Sometimes it's got a little longer tail. But at the end of the day, you still got to measure. You got to look at it in trends across time. But this is the mindset that they had to hold themselves accountable to. And so they're looking at this, and this is kind of a critical point of the measure that they say, gee, if a little bit's good, a lot's better. Let's add 394,000. And I go, okay, so this moves your profit target now to 825. What happened? Well, they didn't make it. They actually just got their money back and a little short of getting their money back. And this is kind of that lesson that you learn of, do you take small incremental steps in growing, or do you take big leaps and make big bets? They were feeling pretty froggy here with 628,000 of profit. And so they bet almost $400,000 extra to say, hey, we've never enjoyed, we've never felt the benefit of profitability in the first place, so we haven't lost anything. Well, they did lose something. Yeah, they lost $400,000 that just didn't work, and on top of what they had spent. And so what they learned was what was working stops working as well. So you got to keep a mindset about those things. And there's a certain limit that the market doesn't accept the next dollar. The next dollar spent over that level is just wasted. Now, those are hard things to know, really hard things to know. And so this is where you earn your keep as an entrepreneur. And this is the reason why I really think you deserve 50 to 100% return on investment, because you're taking big risk, but you've got to take them in measured ways if you want to build wealth every step along the way. Now, fortunately, they didn't, they stayed at the same level of profitability, but in reality, they blew $400,000 at the end of the day. But they said, okay, we think we learned from this. We think we got it. So the next 2 years, they did moderate increases, 166, 154. They had a 91% increase in net operating, or 91% return on investment of that additional spend in 16, a 286% return in the 17. And here's the deal. I mean, this company grew from 700,000 in revenue to 10 million in 5 years. Never used a dime of debt to do it. Now, in these years, you can also see a couple of other business metric things that we talk about. And here's direct labor efficiency. So looking at gross margin per direct labor dollar. So in this case, we knew around this second year what their direct labor target would be, about 680. And they ran hot for a couple of years and finally settled back into the 680, 690 range, which is where we felt like they needed to be. The problem is they wasted money down here. They got a little froggy on their management labor and started adding people, and we're a big company now, we got to add these positions. And they added the labor, and it just didn't really equate into that additional amount of contribution margin. For this particular model, we had actually kind of targeted a 4 management labor efficiency. So we need $4 of contribution margin for every dollar of management labor. They fell off of that in these past 2 years out here in the end. About a year after this, they realized that and had to get back to their targeted profitability. And so they eliminated some of those positions and transitioned some people that it sounded good on the org chart. They just didn't produce at the end of the day. And those are just harsh measures. I mean, the idea is every dollar of direct labor has to produce at a certain rate. Every dollar of management labor has to produce at a certain rate. And I will tell you that it really starts with management labor. If your management labor does their job, does what they're supposed to do, direct labor kind of ends up doing what they're supposed to do. And so the key, we found this management labor efficiency ratio really to be a key measure to get people focused to saying, okay, yes, I need this position on my org chart, and I got to pay this much in market wages to get that person, but that doesn't answer the problem. Does that person actually do their job? Are they effective? And do you need to roll that person out and roll somebody else in if they aren't effective? And those are the harsh things that business requires, but it is what it is, in that process. So, all right. So from there, let me pause, Wayne, and see if there's any Q&A that people want to pose any questions.
Yep. So if you've got a question, you can use the Q&A button. You should see the Q&A button, or you can use the chat button on there as well. Greg, as we're waiting on people to submit their questions, put in some questions here, let me just ask you real quick. And I know this is a loaded question, but what would you say is one or two of the most common mistakes that people make when they look at their financials, whether that's the P&L, the balance sheet, cash flow statement? What are some of those most common mistakes you see people make?
I think the most common mistake is you're looking at too much data. You've got a detailed P&L. Well, first most common mistake is they never look at the balance sheet. And so that one we got to fix, because if the balance sheet has errors in it, the P&L is worthless. And so that's just physics, the way accounting works. So you always look at balance sheet and P&L together. You need to look at them across time, and you need to look at them first in a condensed version to then expand into detail. So if you start at the bottom, you'll never climb your way to the surface in understanding. You've got to start at the surface and go down and drill down to answer questions. And then, really, we're fans of the rolling 12, rolling 3, concept. those are not natively easy to produce inside QuickBooks, Xero, or any of the accounting systems. So a lot of times you do have to take the data out and do manipulations in a spreadsheet or those things to kind of get that information. But on our simplenumbers.me website, there's examples and templates of kind of how you can do that and kind of create a summarized version similar to what I was showing here.
Yeah, thank you for that. So again, I've been guilty of this in the past. For all you watching, listening, make sure you don't just take your financials and throw them in a drawer and say, I'll get to those later. Make sure you're paying attention to them. A couple questions here. First question comes from Annie. What do you look for when selling a business? What advice do you have for company thinking forward? That is, what does it do in preparation?
Actually, so chapter 9 in the first book was actually built around this idea of understanding what we call the economic value of the business. And so essentially there's two drivers to value. It's what is the net income generation capacity of the business, but also what's the equity in the business? Do you carry receivables, inventory? Do you get trade support in those things? And so it's you get a multiplier off of the net income, and it's dollar for dollar for whatever the equity is. And so we believe kind of the neutral value is 3 times net income plus equity. You'll hear a neutral value is like 4 to 5 times EBITDA. Well, the reason why it's 4 to 5 times EBITDA is because it's 3 times net income plus equity, as I learned, because there is an equity component in just about every business. And typically businesses that have very thin assets required to run the business, they generally are going to be a little bit lower, in terms of the multipliers. The key though is prepping looking at your business and saying, are you at a size that makes it interesting to the market? And so there are certain sizes. There's kind of that $1 million and under business market. Those businesses are actually still quite sellable. And there's funds with the SBA to go do those kind of deals. And, sometimes you have to use a business broker to kind of get a broader net of people or available buyers. But there's tons of business transactions right now. There's so much cash out there looking for a place to go that this is probably the most vibrant business purchase and sale market that I've seen. The key is you want to look at it and say, have you done everything to maximize the value in the eyes of a purchaser? And so, because if you've been underperforming and you can perform better, I would tell you, get those things fixed first and get on at least a 12-month run, if not longer, of performance before you try to go maximize the value of the business. If you just don't have the energy, you're going to get what you're going to get. And then, the kind of the concept that I talk about in the new book, the 2.0 book, is realistically, you're not getting a value for the business that you're going to be able to take the net after tax proceeds and reinvest to make a better return than the business you have. That's one of the reasons why I kind of did the calculations, is to show business owners, you have a very valuable asset. You're going to have a hard time getting enough money until you get to about 10 times EBITDA. You really aren't making a good investment decision to sell your business unless you either have fear of the future, you're sick of it, you're ready to retire. Okay, I get it. Those are different reasons. But if you sell for probably less than 8 to 10 times EBITDA, you're not going to replace the earnings by investing it someplace else, except in another business that's better. From a concept.
No, that's great. Thank you for that answer. Several other questions have come in. Jeff asked, with management labor as a key, what are the norms or the averages for that efficiency ratio? Are they vary based on industry, or what are some parameters, I guess?
Yeah, it's interesting. Direct labor efficiency varies by industry. And so it's a little bit of how does labor fall into the value of whatever product or service that you're doing. But management labor is quite consistent, between a 4 and a 5. to be quite honest. And there's a few smaller businesses that are kind of what I would call an owner operator kind of business that you can get away with a 3.5, but I don't see very many that are viable that are probably below 3.5. There are some that can be, and so here's a little bit of a distortion that can happen depending on how you classify things, or kind of, as we say, kind of the play that you run in business. If I hire, really high productive people, and I have more management labor that maybe produces some of that value, I'm going to have a distortedly low management labor efficiency, because really, those guys are helping, create the value. And then other times you're going to see it invert, where I have a low direct labor efficiency and a high management labor efficiency, because I'm really starving the management team. And the way we like to describe it is, if I have a low labor efficiency for my market, it's because I'm not managing. Managing is an active function. It has to be done, or else you're going to get mediocre results.
Yeah, that's great. Thank you. Couple more real quick. We'll run through these. I know we're running out of time here, but just real quick. So for a startup, how long or how quickly should it take, or how long should it take for a startup to become profitable? Are there any parameters around that? Yeah.
Yep. I mean, so I tell a story in the 2.0 book that's built around launching a transmission service center. So this guy that I know, I don't do his data, but I kind of guessed at his data, and he confirmed I was right. He's looking at launching the 16th store of his transmission service center. He said, okay, all right, so you're going to have to go buy $1 million piece of dirt, put up a metal building. He says, yeah, that's about right. He says, great. Well, that's 200. That means I'm going to finance 800,000. That'll kind of get paid for through rent. And then I got a $200,000 down payment. So that's capital input. Number two is you're going to have about $200,000 of opening costs and operating losses until a break even. Typically, he's going to break even by the 3rd or 4th month of opening. And I said, now that's your second capital input. So now I have $400,000 capital input. I said, your go, no-go decision on launching your 16th location is, can you be at $200,000 of profit run rate? So that's $16,667 a month by the 12th to the 24th month. That's when I want to be. I'm not cumulative 200,000 in profit. I'm now running at a $200,000 profit or better, proving I'm going to give you 12 to 24 months to get up to speed. But after that, I got to be at a 50% return or better off the capital I invested. And he said, well, that's kind of interesting. He says, what you just told me in 2 minutes took me 30 years to figure out. And we've applied this idea, whether you're launching an extra location or a new business. I mean, you calculate all of your capital input, and I want you to, of the capital you've deployed at that moment in time, you need to be at a 50% monthly, once you take the annual number. So if you got 200,000, or if you got $400,000 invested, you got to be at 16,667 a profit a month between that 12th and 24th month. And there's a few business models out there that would be longer than that, but you're taking a big bet if you do that.
So let me just ask you, play kind of devil's advocate here on that. What if it's a business that requires very little in the way of initial capital investment?
Right. Well, then, yeah, you're just striving to be profitable as quickly as possible, and because here's the thing. In your mind, you're telling yourself that it takes very little capital investment, but see, you're missing the other piece of capital. I have upfront operating losses. Those are capital. That's capital. It's a loss, but it doesn't get funded by anything other than cash. And so those are capital inputs. And that we don't traditionally think of operating losses until we break even as capital input, but it is. And so we had a client that, if they were going to, so kind of make it simple math, let's say if they're going to lose $120,000 to open a business until they break even, that requires no equipment or anything like that. It's just they're just going to lose money and then until they break even of $120,000, they've got to get to a monthly profit number of $5,000 a month by the 12th to 24th month for me to say, this is a good deal. Or else it's got to have such a stupid high upside, that you're willing to throw, dig this big hole and throw cash into until somebody comes along and offers you a crazy number. And that just doesn't happen in reality very often.
Yeah. No, thank you, Greg. One final question. I know we're slightly over, but just one final question, because I know this is, it's an interesting question, and it ties directly to your first book as well, maybe in the second one. But you talk a lot about that owners of businesses should pay themselves a competitive wage and not rely on
Absolutely.
taking draws out of the company or distributions out of the company.
Absolutely.
Why, other than staying within, reasonable salary ranges of the IRS, why do you recommend that? What's the reason?
Because you're looking at financial truth. One thing I'm a huge fan of, if I was going to go back to college today, I would actually get a degree in behavioral economics. It's interesting to see, kind of my passion is finding different ways to display data differently to get people to act differently to their best and to their best benefit. And so what I find is, if I'm letting myself off the hook by taking distributions to make myself feel better about my bottom line, I'm not pushing the business hard enough. And I got news for you. I got a personal example of this. So, for 30 years prior to merging with Carr Riggs, I underperformed. And you know why I underperformed? Because I wasn't accountable. I mean, I was the majority shareholder, and yeah, I had partners, but really at the end of the day, I kind of did what I wanted to do. And if there were things I didn't want to deal with, there wasn't anybody holding me accountable to do what I professionally know is the right thing to do. Since we merged, I'm the partner in charge of this office, and I'm held to a list of KPIs that I openly share this, that I'm better because I'm held to these KPIs. They're not asking me to do anything unreasonable, but if my work in progress is outside of a certain mathematical range, I got to write up a report as to why. And I got to detail it for each client who's on that exception. Why is this happening? I don't like going to the principal's office, but it's a good thing. And that's really, I would tell you is, I mean, I left thousands of dollars of profitability on the table, just because of accountability.
Yeah, that's good. Thank you for that, Greg. And thank you for taking your time out of your day to come and share with us. And for everybody watching, for some of you, you will be winning a copy of Greg's book. So thank you so much for participating today. I highly recommend both. As Gary said it better than I would say it. He called this book his Bible when he's coaching entrepreneurs, and possibly this one will be his New Testament. So you can't get a much better endorsement than that from Gary. Greg, again, that. Yeah, thank you for your time. And thank you so much for everybody who's here watching. Keep an eye on your mailbox for those of you who win. We will be going through that process at the end of this week and getting those in the mail to y'all. So thank you so much.
All right. You guys keep trucking. I appreciate it.
Thanks, Greg.
Thanks.
Thank y'all.